Another incredibly turbulent week. Has anything changed for you this week? And if so, what?
A lot has changed. And I think, particularly as it relates to the bond market, some of the moves that we've seen from central bankers globally, this jobs report this morning, this blockbuster gain and payroll growth is really adding insult to injury for people that own bonds. We started the year with this big backup in rates. And normally when we see equity markets correct, bonds come in and act as your friend, act as your diversifier.
Yeah.
And we haven't seen that this year. We've had almost a perfect storm of still elevated inflation. We've had, oil prices surging, partly based on this tension between Russia and the Ukraine. And then, of course, we've had this re-rating of expectations as it relates to a tightening central bank policy. So we've seen this really meaningful backup in rates. Bonds have not been there for investors. And we're often reminding ourselves in times like this that investors tend to really hate owning bonds right before they love owning bonds. And that's what we're looking at now. When we look forward to the rest of 2022, we see a decelerating economic growth environment. We actually think that starting in April, you'll see inflation really moderate as those base effects start to fade. We also see a continued flattening of the yield curve, which we should benefit the intermediate part of the curve. So we're hanging in there, but certainly a tough day and a tough week as far as owning bonds.
Well, and let's talk about the relationship between bonds and the equity market, because real yields have been deeply negative for a while now. And yet today we have a 10 basis point move upward on the 10-year real yield. We're sitting negative 47 basis points. The equity markets, and particularly tech stocks, are holding in fine. How high can that real yield go, and how quickly before it starts to cause way more turbulence on the stock side of things?
Yeah, look, if we're seeing real yields go up, not only because nominal yields are moving higher, but also because inflation expectations are starting to come down, which is what we're seeing when you look at TIPS break evens, we'll take that. We think that that's actually a pretty healthy environment. When you see nominal yields rise based on, still positive growth expectations, that's a good thing. Again, we see inflation moderating off of these levels. So we think equity markets can actually handle it. But what we are looking for is this transition into this part of the cycle where you want to fade those lower quality winners, so the unprofitable tech companies, and you want to look more at the quality space. So right now we're emphasizing stocks and sectors that have great balance sheets, tons of cash on their balance sheets, great margins, ability to grow organically, even as the economic backdrop returns to more normal levels. So we're looking at that intersection of quality and growth, and you're finding that in technology names. We're also looking for that intersection of quality with value. So, of course, cyclical parts of the market really doing well to start the year, but not all value sectors and stocks are created equally. So we're emphasizing areas like industrials, which have the best earnings growth prospects among S&P 500 sectors for that value quality play.
Emily, can I just come back to the bond market and get your take on what happens next? Because we've almost halved since the beginning of the year the amount of negative yielding debt that there is out there. We've obviously seen a huge pivot from the ECB. We got that yesterday. We've now got a German 10-year that is positive. There is talk potentially that we could have the deposit rate for the ECB being positive or at least flat by the end of this year. What are the implications of that for the US bond market?
So I think the bark might be a little bit bigger than the bite, not only as it relates to European policymakers, central bankers, but also as it relates to the Fed. If you think about the language that Jay Powell has used, the job owning that's gone on, we're almost getting those tighter financial conditions that the Fed wants to see in the form of some of the froth being let out of the equity market. We're seeing, looking at high yield bond spreads, those have widened to over 300 basis points, not at levels that suggest we have a liquidity issue by any means at this point, but you are seeing financial conditions here start to tighten. So we think that has critical implications, but we think a lot of that is already priced into the market. So we're actually taking the under in terms of the consensus expectation on how many times the Fed raises rates. We think maybe it's more like 3 to 4, not 4 to 5. Earlier this week, I heard things like 7. We don't see that happening given the shape of the yield curve. I think one of the most notable developments this morning was, yes, bond yields have backed up, but the yield curve between the 2s and the 10s is actually still right around 60 basis points. So I think it's going to be really difficult for the Fed to raise rates 5 or more times, given the shape of the yield curve and the risk that they risk inverting it into this slowing growth backdrop.
So with that in mind, is that going to create more upside potentially in the second half if the Fed begins to tighten earlier on in the year and then takes a pause due to some of the forces that you're talking about?
Yeah, I think it has the possibility of extending this cycle. So right now, what's happening is this cycle is aging rapidly. It usually takes a lot longer for the Fed to start to tighten. And now, because of inflation, they're really being backed into a corner. And certainly, higher oil prices aren't helping. If the Fed can note that economic growth is returning to more modest levels, we have a fiscal drag that we need to remember into this year, and they can start to back off a little bit. We think that that has the ability of keeping this cycle moving, extending this cycle further, which would be a positive here for risk assets. I don't think it means that you want to load up on risk, but I do think it means you want to continue to emphasize equities in portfolios. And we would be looking amidst the rubble right now in this corrective price action and looking for opportunities in those quality areas that we talked about.
Can we just circle back to the stock story, circle back to what is happening elsewhere? WTI crude now 92.57. You got Brent crude at 93.12. That gap seems to be narrowing quite rapidly out of interest. But in terms of what you're doing with energy right now, how should we be thinking about energy? Stocks have had a great run, but I'm wondering how I think about the energy story. Are people using Brent as a hedge right now? How much of that do you think is financial flows? How much of that is real demand flows? Do you think if we are going to see the inflation story abating later on this year, that we start to see, is implicit within that the fact that energy prices are going to come down, and by extension, energy stocks as well? How are you thinking about the space right now, Emily?
Well, I'm thinking that when I wake up every morning, oil prices are up, and they've just been, seeing this relentless price appreciation that's surprised us. And I think the one element that maybe you didn't mention that I think is important here is sentiment. We have, fears of an energy crisis, not only here in the U.S., but overseas, that's building on sentiment. Oil is one of the only areas of the market that's up, or energy stocks are up to start the year. So investors are looking there. You talked about flows in your last segment. That's where investors are going. Maybe you can call it the safety trade of the year. It's really the only place that we've seen positive action. The problem is the energy sector is so small. It used to be 2% of the S&P 500. Now it's about 3.5%, given the price appreciation of the past year, that it hasn't been enough. We actually see oil in a longer-term secular decline. And even as we head throughout the rest of the year, we just don't see where the demand is coming from. You look at things like TSA throughput. I know I was at Logan Airport a couple of weeks ago. I felt like I was the only person there. We look at demand for things like gasoline at the pump, and that's actually coming down. So it's hard anecdotally to see where that massive demand is coming from in the energy space, other than simply the sentiment that's pushing energy prices higher. And the flows that are going there is one of the only places that are working in this market so far this year.